In this video, we're going to be providing you with an overview of UK corporation tax, what you need to know to understand why you're getting taxed, how you're getting taxed, when you have to pay, and how you can minimise it. What is corporation tax? Corporation tax was introduced into the UK tax system in 1965 as a separate tax specifically for companies. It accounts for between 6 and 8% of UK tax revenues. Who pays it? Corporation tax is paid by UK resident companies as well as overseas companies that have a permanent establishment in the UK. Corporation tax is also paid by clubs, cooperatives and other unincorporated associations, for example community groups and sports clubs. For simplicity, I'm just going to refer to companies in the rest of this video, but understand that I mean any entity that is liable to corporation tax. When do they pay it? For most companies, corporation tax is payable 9 months and 1 day after each period end. There are special rules for large companies which require them to pay their corporation tax quarterly instead. How is it assessed? Corporation tax is self-assessed. That is, companies are obliged to self-assess how much corporation tax they owe and complete and file a return along with their calculation. It is then up to HMRC to challenge that self-assessment if they believe it to be incorrect. How much is it? As of filming this video, the current rate of UK corporation tax is a flat rate of 19% for all companies. However, this is expected to change in April 2023 to a main rate of 25% with relief available for smaller businesses. From April 2023, companies with taxable profits under £50,000 will pay tax at the previous rate of 19%. For companies with taxable profits between £50,000 and £250,000, the tax rate paid on all profits will be on a sliding scale between 19% and 25%. The higher the profits, the higher the tax rate. At profits above £250,000, the full tax rate of 25% will be charged. How is it worked out? Corporation tax is charged on a company's taxable profits. Very simply, taking the current tax rates, if a company made a taxable profit of £100,000, the corporation tax it will pay is calculated by multiplying those profits, £100,000, by the tax rate, in this case 19%, to get £19,000. Taxable profits are not necessarily the same as the profit figure you might see in a company accounts. This is because certain items are treated for tax differently to how they are treated in company accounts. When we say an item is tax deductible, we are referring to an item of expenditure that is eligible to be deducted from the company's profits before the tax is calculated. It does reduce the tax payable, but only at the relevant rate of corporation tax. So something that costs £10,000, which is tax deductible, will save the company £10,000 at 19%, so £1,900. Whilst most types of income and expenditure will be included in the taxable profits, there are a few that are either excluded completely or have different rules. Sometimes these rules can be very complex, and it's beyond the scope of this video to go into detail. We'd be here for hours. But we can give you a brief overview of some of the more significant differences. Dividends and salaries. Salaries paid to employees and directors will usually be tax deductible, as will pension contributions, but dividends paid to shareholders are not. As the directors of many small businesses are often also the shareholders, for tax efficiency, they are often remunerated by taking a small salary with the remainder taken as dividends. So it is worth noting that corporation tax is always calculated on profits before taking dividends into account. This can be confusing for small business owners, and it is always worth getting advice from an accountant to ensure that your remuneration structure is set up in the most tax-efficient way. At Cunningham's, we look at not only the impact of corporation tax, but also consider income tax and national insurance contributions. When making our recommendations, we also consider the financial requirements of the director shareholders and also alternative methods of drawing money from the company, such as pension contributions, dividend reinvestment in tax incentivized share schemes, and benefits in kind. Depreciation and capital allowances. Depreciation, being the amount that is written off the company's assets each year to reflect their use, is not tax deductible. Instead, companies receive capital allowances, which are a standardized tax relief on the purchase of assets. In most cases, capital allowances are actually better than depreciation, as they often allow a company to claim the full cost of a new asset as a tax deduction in the year it's purchased. Depreciation would force that deduction to be spread over several years. Capital allowances are also used to provide incentives to companies to purchase specific asset types, which can sometimes give a greater tax deduction than the amount spent on the asset. We always recommend speaking to your accountant before making any significant asset purchase in order to ensure that you're going to be maximizing your tax relief from capital allowances. Research and development. Companies that undertake any form of research and development to advance technology or know-how are provided with tax incentives that allow them to receive extra tax deductions for the money they have invested in these areas. This is an area that the government are keen to push, since innovation helps to grow the economy, and the tax deductions are quite generous. It is always worth reviewing what qualifies as research and development expenditure, since the definition allows more companies than you would think to benefit from these incentives. Buildings. Unfortunately, for companies investing in buildings, the purchase price of the building is not tax deductible, at least not right now. Companies are able to claim tax relief for the original purchase price of a building, but only when they come to sell that building. That could be many years ahead. There are some instances where some aspects of a building, the fixtures and fittings and integral features, can receive tax relief when purchased. So it is well worth discussing the purchase with your accountant before you make it, as they can help you to get tax relief in these areas. Summary. I hope you now have a good idea of what corporation tax is, who pays it, and how it's worked out. If this video has been helpful to you, please do click the like button below and subscribe to our channel if you're not already. If you have any questions, please do post them in the comments below. We'll respond to every one. Thanks for watching. I hope this video has been useful, and remember, sometimes just one thing is all it takes. See you on the next one.